Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants.
This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast.
All right, let's kick it off. We've got Andrew and Claude in the house. We're swinging into earnings season. We're just finishing up 4C. We'll run through a few of those. Got a bit of... Andrew, do you want to just run through a bit of what happened with Commonwealth Bank? Actually, do we have any good news? We talked a lot about stuff last week. Have either of you guys had any good news across the week?
I'll give you a bit of bad news. The LK99 stuff's looking pretty bleak at this point. So
yeah, the odds are down. Well, good news. You got any good news?
No, I actually don't. I haven't seen anything.
Okay, let's see some good news. Groundbreaking brain implants restore hand control and hope for paralyzed man. Let's just go with that one.
And those of us that want a robot arm as well.
Yeah. For those of us wanting a mechatronic suit, also good news.
I guess, it should be a nice summer, right? This is only going to be the first El Nino, so Australia shouldn't burn yet this summer. So...
The most pessimistic good news section in Australia.
Can I tell you, this is what really sucks. So, the last rental place we had a pool. It's the first time I've ever had a pool. The only time in my life I'm sure I will ever have one. And it was the rainiest, coldest summer on record. And now we're in this other...
I love how you managed to relate global weather patterns to your rental.
It just where's the luck, And now it's going to be a proper summer, and we barely got an air conditioner that works. So anyway,
yeah. So what is the weather pattern, Claude? Because I have actually seen the people talking about this a bit in regard to
Actually, sometimes there's market implications for El Nino, right? I can't really remember. I remember thinking about it relative to bees once upon a time.
Bees.
Remember Capilano honey? That was a cracker. Yeah, so now it looks like we're going to go end the La Nina cycle, which is where we've had so much rain, and then we'll have drier summers from now on. I guess the classic hot summers millennials will remember from their childhood, because we had a 7-year El Nino run when we were teenagers. And yeah, it's dry, hot. If you're at the beach, it's pretty nice. No rain.
Yeah.
And yeah. So the first time, before it starts all burning, at which point I really need to make some sort of plan for what I'm going to do when that happens again.
Well, apparently it was the hottest July ever. And what was really interesting, I don't know the validity of this, but I've saw some stuff where a lot of shipping has not been happening for various economic supply chain reasons. By the way, the stuff out of China is looking pretty bleak at the moment. That's
you mean basically this is the switch from supply, it's from goods back to services. So basically we've bought all the stuff and there's less physical volumes being moved for a lot of things.
Yeah, and something to do with a lot of the sea lanes not being as active as they are, which means there's been less pollution from those boats, but actually some of that has an unintended reflective consequence.
Oh yeah, I was actually thinking to mention this one.
Yeah, you might. I'm shooting from the hip here. You might give us some properties.
Well, yeah, there's two things to it. So one is the boat's activity, but the other is that we've got rid of they used to have a lot of sulfur in the fuel, and a few years ago they mandated getting rid of sulfur. So sulfur is bad for humans to breathe in; it can cause diseases. But by doing so, they're significantly contributing to warming the planet by getting rid of pollution. So it's quite paradoxical. Basically, because the sulfur used to go up in the air and make the clouds brighter. And so by getting rid of that, they're kind of effectively doing geoengineering by removing the prior geoengineering we used to do. So the clouds are now less shiny, and so therefore less reflecting light back into space. And so therefore the Earth is heating up more, which is it's kind of bizarre, and I think that's
better explained.
Yeah,
actually, you reminded me of some good news though, Matt, that I even bookmarked, and now I saved it just for you. At the end of July, there was an article published, or a paper rather, an interrupted time series analysis of the cardiovascular health benefits of a coal coking operation closure, which basically found that when the Shenango coke plant in Pittsburgh closed, you immediately had a massive immediate benefit in terms of fewer cardiovascular exacerbations ending up in hospital. So it just shows the upside there could be in health when you close a lot of polluting industries such as coal, but also just as we transition to EV, which is a bit of a problem given Australia is so slow at that. But there's actually genuine upside there, which comes back to my age-old property play, which is like buy an apartment near a busy road that kind of like stinks and is a bit loud at the moment. And then it all turns into quiet, clean EVs, and suddenly the big street trees come to the fore and it's more peaceful.
Yeah. No, that'd be nice. I often think about that on a busy road, how much nicer it'll be if we get fully EV. Cool. All right. Well, let's jump into Andrew. Maybe not good news, more macro stuff though. But a read through from Commonwealth Bank. You're sharing some charts in the chat before. What's your kind of read from the high level of the?
I'm laughing because you said, are you just like hate reading and looking for like confirmation
property
bias
crash.
on property crash? Like, yeah. Yes, I am, Matt.
Just kind of surprised me. You were like, so into Commonwealth Bank results.
Well, look, this does not fit a baby giants, mandated discussion. This is not a baby giant. This is a giant giant.
There are mandated discussions here. I'm out.
But look, the cash profit was up 5%. They made $10 billion. Things are pretty solid with the bank. It's like
basically you're annoyed because it's all going well. Like the crash isn't happening. Would that be fair?
So it's a 126 page preso, right? So you will find whatever you want to find within all of that. So I went looking for the bad things.
Yeah.
And actually, look, I'll be fair. It's not that bad. But a couple of things I thought were worth sort of highlighting. The level of funding through deposits is the highest it's been for a while. So 3/4 of their funding comes through deposits, which is the cheapest form of funding for a bank. The rest has to come from wholesale markets.
Can I just ask you guys something about that? How does Commonwealth Bank have deposits? Like, I literally see they're like an insult to my face. I look at my Commonwealth Bank high interest saver account and it's like 2%. Is Commonwealth Bank like psychoanalyzed me and particularly got it in for me and actually offering 4% to other people? Or like, why is any like
Dolomites, Claude? They got you with
I'm like,
what's it called? The like piggy bank scheme for children. Is that Dolomites?
I had to open.
That's been banned since.
Oh, has it?
I couldn't find my little thing.
They got Claude hooked early before they banned it.
That's how they got me.
Anyway, in the end, I opened up a Macquarie Bank account so that I could. So did you move a lot across, or do you still keep some in there? Yeah, so I've been trying to keep my cash over in the Macquarie one, but then I've got an interesting thing for anyone that does have an Macquarie account. There seems to be some sort of glitch in the interface or something whereby if you open a term deposit and then try and select not to reinvest your term deposit, or if you call up and ask them, hey, make it so that it doesn't reinvest, it just pays out at the end, they change it on their phone end, but it just won't update on the interface you're looking at. So you repeatedly try and change it. It keeps on saying, no, it's reinvest principal. And I guess it's some glitch that they couldn't fix. So in the end, I just got sick of it and just like complained to the Financial Complaints Authority or something like that. The whole process took a few months. I got a letter from Macquarie saying we absolutely confirm in writing that it's not going to be reinvested, and they paid me like $300 compensation.
AFCA is a tiger.
So that's my strategy for getting $300.
Okay, that's okay.
Intended at the time, but it worked out.
It's a lot of effort. They're useless. Banks.
I feel like it was actually good ROI on time, man. I reckon that email to the Complaints Authority took me about 8-10 minutes.
Anyway, I won't get into why I complain.
Yeah, nice.
It was figuring it out that it was the brain cells I lost in being like, what is going on here that really cost me though.
To answer your original question,
sense.
I haven't looked at the detail, but it may be that they include offset accounts in that deposits. I don't know, maybe. But it's always interesting though, because they have to go to...
I think that might be a big part of it, because that makes a lot more sense.
Like that's a guess, right? So don't quote me on it, but if I checked, it might be that. But still, that's pretty good. So, I mean, it wasn't that long ago where it was only 2/3. And of course, the difference is made up by selling bonds essentially into offshore markets. And we know what's happening with global interest rates, which means that it's much more expensive funding, yada, yada, yada. So that's kind of good. It's a really interesting question you pose though, Claude. Like, why don't people move their money? Because you can get like really like superior rates of interest elsewhere. And I think it's just, we've had this lesson a gazillion times in a gazillion different ways, but we are not very rational economic actors, and we're just lazy, and there's huge amount of inertia in these kinds of systems. And that's the reason why we don't, right? And so anyway, that's good. That's good news. Troublesome and impaired assets, TIA, increased 11% to $7 billion. They had to lift their provisions by 57%. That sounds pretty bleak, but I mean, we're still talking about like ratios that are less than 1% of the total loans they have. So these are very, very low and low historically as well. So there's nothing that's really showing up there. The loan expense is actually doubled since FY21. Again, super low base. So I'm not reading too much into that. This was interesting. So we've all heard of the mortgage cliff. That's really a known. They put out one of the charts there is they've still got a third of their mortgages are yet to experience higher rates. And in terms of the sheer numbers of their fixed rate expiry schedule loan, the expiry schedule of their loans, majority is coming out in the 6 months to December 23. So we haven't had it yet. And then even in the 6 months to June 30th, 2024 will be higher than the 6 months we've just had. In other words, there's still a lot more to go that are there. So that'll be interesting. What's another interesting thing? Oh, another reminder for me of just how bifurcated the economy is. There was a really nice little chart in there that just shows you that, if you're a boomer, things have never been better. Like your deposit balances are great. You're getting more interest on all of that. If you're age 35 to 44, like life sucks for you. And they really called that. I think the head of the chart title was like, pain is not being evenly felt, which is probably the understatement of the.
Yeah, so I think that's a really good point, Andrew, because something that got missed and I didn't appreciate, and I think a lot of people now are realizing in the US, is how insensitive to rates households are. And part of it is this 30-year mortgage thing they have there, but the other part is that a lot of people had a lot of cash that wasn't earning any interest. So you have this bifurcated, as you called it, kind of two-speed thing where for a lot of people they make a lot more money, and that all the over 65s, or a large share of them have savings. They're now earning a lot more on the cash that they'd held, and so that's offsetting this kind of pain that younger people are feeling. And in one of the charts you shared, I think it said exactly that, right? Like the savings rate for 18 to 24 is down and 65 plus is up significantly. So.
Yeah, that's right. I think that's the big takeaway for millennials and below is that at this point in the last month anyway, and less so in the last 3 months, there's been a bit of a slowdown in spending amongst those age groups, which could be an indication that, I guess, pay rises aren't, the pay rises have come through, or they're not going up much, and that these guys are not being able to increase their spend with inflation.
So also in that same chart, we saw like the change in savings. I mean, below 34, it's all gone backwards. Above 65, it's gone up massively. So there is that. A couple other things I'll call out. I mean, one of the things that really, I don't know what the situation is overseas, so maybe I'm just being too curmudgeonly, but it strikes me. So CBA, I don't know what, look, one in two Australians benefit from this, right? Because we have exposure, if not directly through our direct portfolios, but through our super balances. So like CBA is pretty much held by half of the country. But what strikes me is that this is a business that is a business about home loans. Like when you look at their balance sheet, 70% of the loans that they issue are for home loans. And if you look at the business loans in terms of their lending book, so they got like $930 billion in total group lending. Only 17% of that is for business. And that just, I don't know if you guys know what the averages are in other Western democracies, but it just strikes me as like, that is a very non-productive use of capital to me. And I just find it more than a little bit depressing. And of those,
mate. It is. It's
you
very
think so?
non-productive.
That's
like, the problem. It's become it becomes an inequality tax, right? Because just the cost of being is so high, or to have a business premises, or to put a roof over your heads becomes so high. And once upon a time, mate, there was huge, much bigger expenditure relative to population on just public housing. I mean, please, can we do it? And the answer is inevitably no, because somebody, doesn't want apartments built around their house. And I have to say, given that I'm currently living in a house that's had apartments built around it, I've got zero sympathy for lack of apartments being built, because it just has to happen. It's the only equal thing to do.
Yeah. So this is the biggest lender in the country by a pretty decent margin. It should be said. So it just strikes me that, and one of the biggest companies, if not the biggest company on the entire ASX, it's just sort of like Australia really is all about houses and holes. And I think there's an index I saw recently. I'm going to have to make the numbers up because I forget. They talk about economic complexity, I think it is sort of like, so Singapore's a very diverse kind of economy. It's got lots of different components and levers to pull. We are literally dirt and houses, and it's a very narrow economy, which is not good in terms of resilience and just general prospering of humanity. A couple more quick ones, just then I'll shut up about CBA. So 70% of loans that they issue are for home loans, only 17% are for business. 28% of the loans on their book are for investments. And in the last 6 months, that's accelerated. So 32% of all loans issued in the 6 months to June 30 were for home loans, and 21% of loans were interest only, which I just thought is interesting. Okay, I'll shut up now. Over to you guys.
Oh, I just wanted to chuck in the one headline is that also, I don't know if you mentioned, Andrew, but home loan arrears over 90 days were actually down slightly over the last year. And the 30-day plus
up over the
arrears,
6 months, down over the year. But
but the 30-day other arrears were up slightly, but again, still they're under 1% there. So
and below long-term
still tracking.
averages. So things are holding up remarkably well. I guess the other thing to think of here, which is interesting, is that I don't think this is going to happen, by the way, but I just think I don't know. I find it pretty interesting. So they've got consumer finance, business loans, institutional loans, but if you just talk about the home loan book, if that dropped by 12% in value, the bank CBA would be insolvent.
Yeah, you're still death rating it. I got it.
I find it just the quality of the assets, the resilience of those assets. People do whatever they can to make sure their homes are repaid. I don't think it's any imminent risk whatsoever. But I think other businesses, I think we would look at balance sheets like that and go, wow, that asset only needs to drop by that amount, and you're insolvent. You would consider it fairly risky.
Can we segue into, I know this is unplanned, but did you guys have a look at Charter Hall, WALE, REIT that dropped like 20% the other day?
Oh, I saw it.
Yes. The ticker?
Yes.
No, talks about that.
Well, I always ruminate on this because I don't know why. I guess if we were to dissect my psychology, it's like I have a problem with lack of ventilation in offices. Therefore, I'm like happy for people not to work in offices. And I was getting super triggered by articles in the AFR last year being like, back to the office, ta 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 ta, what about the coffee guy at the office, ta 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 ta. And so I've been kind of doing my own death riding of CLW, which I'm like, yeah, go down. And yeah, like sure enough, it did. And I think that the key point that I wanted to make that I thought was interesting is, there's this increasing recognition, I guess, by the market that the NTA kind of that they put out previously is just not very well grounded in current reality. So it's definitely a situation where I think, we brought it up last week. We had the question about it. I just wanted to chuck that in and say, well, look, we got another result. The results came out for this company, Real Estate Investment Trust, and the share price dropped promptly, like around 10% or something like that, which for these, supposedly steady, sturdy dividend kind of distribution stocks, is a bit of a hit because I guess that's like more than that's a year's worth of dividend gone or something like that. It's sitting at certainly 5-year lows, pretty much 5-year lows.
It's interesting, Claude. I think they're worried about the debt covenants. So they're a mile away at the moment, but it's just this situation which is sort of the covenants based on the asset value, and the asset values are sort of determined by valuers. And you could argue, I think I would probably argue, that the real test is the market itself. So you're in this, I think this was in Chanticleer actually in the AFR. They made this observation that so you might want to sort of give yourself a bit more breathing room, in which case you might sell some property, in which case you might find that the carrying value isn't anywhere near the market value. And carrying values are often referenced by looking at market values. And so you sort of get a bit of a death spiral there where you could see not a forced sell, but an encouraged sale in some of these assets forcing more write-downs on the books, which increases debt covenants, et cetera, and things just get potentially a little bit interesting.
Yeah, you can get kind of that cascade or spiral.
Yeah, that's the word I'm looking for. Yeah.
Yeah. What would it take for these things to actually get? I mean, it's never going to happen, right? Am I correct in saying it's never going to become an apartment?
Yeah, I did look into this. We talked about this like a few months ago, didn't we? It's not as doable as it used to be. So our buildings used to be built with much smaller floor plans and use natural light, like the office buildings. And so you could convert a lot of the old ones to apartments pretty easily. But the new ones are all built with these monster floor plans where there's not much windows nearby, basically. So that's one. And then the other is all the plumbing. Apparently, it would cost more in most cases for any recently built buildings. It would cost a lot more to redo them all. The other thing was, that's right. They use something called high tension concrete flooring that you use to like do the flooring level. And it's like, it means that you save a lot on having to have a lot of other like load bearing weight around it. Like the floor bears a lot of the weight, but then if you cut through it, you weaken it immediately. So it's like, you can't cut through the floor to put in a lot more plumbing. So a long way of saying it's not as doable for recently built stuff as it used to be. It used to be like quite a big thing, and now is becoming much harder for a lot of the like new, more recently built stuff.
I wonder if that's the play then. I wonder if there's some older, nicer office buildings that it would actually be something someone could do.
Yeah. Yeah, it's not a bad idea. Let's pivot to some small cap good news, guys. What have you got?
Yeah,
first?
sure.
What have you got this week?
All right. So, well, yes, I guess I'm your sponsor of the small cap good news. We need a jingle. We need a jingle for it.
Yeah.
Okay, we'll work on that.
Work on that midweek. I'll give you a drum roll if you want.
Boom. All right. The drum roll can be for Redbubble. You know that. Perfect. Keep it up. Let's keep this segment spicy. Yeah, so Redbubble definitely deserves a gong for the good news. Actually, actually, this is kind of old now. I wish I'd brought you this the day it came out, because it's very much been, I'd argue, priced in. But it came out with the news that it had received favorable rulings from the US Appellate Court. And if you recall from when I started ranting extensively against this stock when its share price was about $3.40, one of my major concerns was that at that time, they had lost a case regarding copyright infringement on their platform, and that really created a bit of an open-ended risk. And I believe that in any event, they sort of reeled in the copyright infringement on their platform in subsequent times, but they still had this overhanging risk. And they have now had some favorable rulings, which probably, give them more protection, of using, ignorance and not knowing about it. And so a little bit more likely that there's less of a problem for them in the future regarding copyright infringement. And depending on your interpretation of the rulings, it could even, and also depending on what their current copyright policies are, which I don't know exactly how they do it with their algorithms, but it's possible they may even have more latitude to take a few more risks in that regard now. So I would hope as a shareholder they didn't take on more risk there, and I have no idea if they would. But I think they may well have room to, based on at least where the current law is. So that's definite positive. And it's also just the removal of risk. Of course, we did see a massive share price boost since then. The initial reaction was a bit slow, which I was very surprised at. And the degenerate in me definitely wanted to, impulse buy shares, though I have been refraining from that kind of behavior these days.
And they've come back off a bit since, as you say, right? So,
yeah, they have. The problem is, the reason I hesitated to be like, because it was up like 4 or 5% at first. And I was like, wow, this is a surprisingly small move, given that it's coming off June tax loss lows. Stuff like Setai, Temple & Webster, even Kogan, I think, have bounced pretty hard, and it was still sitting at its lows. So I felt like there was a janky trade in there, and the market did indeed provide that. And I'd say that perhaps the easy money's there in. But having said that, I still, definitely skew. I don't have to have a view on every stock, and I don't have an overall view on Redbubble, but I do want to put on record that, whereas once I was like heinously negative, it's like down 80% since then. They've had this huge risk removed, or not removed, but minimized. And on top of that, the founders come back in. They've removed a lot of employees that were costing salaries. They're basically saying, full steam ahead to get to sustainability and profitability. And they've never really created much of a track record of sustainable profitability. My base case would be that they managed to string together some, slightly better looking years, and and perhaps achieve some sort of re-rate on that, though wouldn't be, particularly confident in predicting where market sentiment would go, because of course you do have a lot of people that would be nursing wounds from the big crash from $7 to 30 cents or whatever, 40 cents or whatever it got to. So sometimes that would mean actually the sentiment will stay low. So not one I'm enthusiastic about, but definite good news for that, and also a big move, so deserving that drum roll.
Very nice.
Any comments on Redbubble?
Yeah, some of the stuff that they're doing to hit profitability is like increasing fees for artists a lot. And so that's something that there's been like really big pushback from some of the artists. And so it's an easy one to do short term. And I guess the danger is, does it like undermine the platform longer term? So that'd be something I'd try and watch for, any kind of read through on that, because that could generate profit, but kind of kill the idea of it being more than just a print on demand shop.
I completely agree, Matt. And I think I think that already the idea that it's anything more than a print on demand shop is wrong. Like I'll kill that, and I'd happy if it goes back to $3.50, I'll slay it again because it's just wrong.
Yeah.
However, the print on demand shop still has a value, right? And you can still be a good one or a bad one, and probably a good one who has more scale would get a slightly higher margin.
Yeah, no, agree.
And that's also the source of, like, you could be like, this is a print and demand shop that has a cool little competitive advantage, which it has a lot of links out there in the environment where people are saying, here, buy my thing. And I think that's where it's interesting. Obviously, plenty of competitors. And anyway, I've dissected it before, but interesting enough. But I think that what you're spot on, because I fear that might be the real death knell of their narrative there.
Yeah. And then if he stops being CEO again, that would be the time to sell, because that's the top.
Definitely. I'm 100 out. I mean, definitely not playing round 2 on this. Like, yeah, if that guy quits again, you're like, yo, I'm out. Okay, moving on. Okay, second bit of small cap good news is AEF, and I'll definitely let you guys have a few thoughts about this old fund manager.
Australian Ethical. Yep.
Yeah, Australian Ethical. The good news was pretty much just I don't know how much actually the news did drive the share price. It might have also just been benefiting from a little bit of a pickup from the end of year tax loss selling. But they did put out their FUM announcement. They've benefited from getting stuff from Christian Super, but nonetheless, total FUM now at 9.2 billion. I've watched this company, build up from $1 billion basically. So it's going a long way there. Really, the majority of that is in superannuation. Net flows were, for the quarter, I think, were 200 million or 190 million for super. So gives you an idea of where they're sort of pacing there. And also these guys are, I guess, pro-cyclical. They benefit from the market as well. So the market was up, that goes up as well. They also recently put out their underlying profit guidance, which was a little bit before. And yeah, generally speaking, I would say this is an interesting one because it does have, I guess, a better than even chance of increasing its funds under management. And I would genuinely say, you look at something like Platinum and Magellan and that kind of thing. And when you start getting outflows in this fund management, it gets pretty ugly. So yeah, good to see continuing inflows for Australian Ethical. And even though they are a high PE ratio, definitely this is one that I appreciate the thesis for, because you got to remember that their client base skews younger. And also for a financial services company, they have a pretty good brand. Like, there's lots of different ways to compete on, but having it in your name, once they've got these people on board, as a client of Australian Ethical, you get communications like once a year or so. They like email us and tell us, select out of these 30 charities which ones you want to donate money to and stuff. As long as they don't blow up on returns, I think that they probably will have a fairly sticky user base overall, or client base, I should say.
Nice. Do you have any thoughts on that one, Andrew?
How did they get the $14? What was going on there?
I think it had basic meme stock. So I think, from memory, correct me if I'm wrong, and I'm going on pure scuttlebutt here, but one of the major, flagship newsletters of our former employer, I think, might have recommended this one a couple of times. And generally markets were going up like nothing else. I think that this one has a bit of appeal to like young people. They might be familiar with the brand. Yeah, share price momentum, good story, quality stonk kind of thing. I think it basically became a bit of a meme stock.
Wow. Because that was like 15. Actually,
fairly liquid as well.
Yeah, it was like actually almost 15 compared to the current share price of 4. The current share price of 4 is, as you say, a pretty high PE, 46. And the yield of 1.4%, like that's,
yeah. Yeah, even now, you would still say it's quite expensive for a funds manager.
Yeah. I mean, where I'll give them so much credit, I mean, it's just such a masterstroke of marketing. I'm going to put my cynic's hat on here as well. I think the ethics are in the eye of the beholder here. I mean, just looking at their Australian fund here, there's a whole bunch of stuff in the materials sector. And again, I'm not here to say that it is or isn't. I actually think there's a lot of, we need resources. So I'm not going to take a myopic view here. But you know what I mean?
That's not got nut. But I know what you mean, but that's more of a discussion about ethical. That has no impact on Australian ethical. Like the people that are investing in it aren't like, oh, screw this, I disagree with your investment in this obscure company. Like they do, but then that manifests in them like writing to Australian Ethical and be like, sell your shares in Tazcell, sell your shares in Tazcell, and then eventually Australian Ethical does it. Or Lend-Lease, I think, was the latest one. Like it doesn't affect them. They don't lose anyone. What happens is enough people cry at them to get rid of Lend-Lease. I was one of them. Then they do it, and then that further builds the brand.
No. I'm coming from a different angle. I say that you're the exception to the rule. I would say most people go, I want to invest and I want to do it ethically. And this one is ethical. Australian. Okay, I'll go with them. That's the thought process, right? So I'm not saying they're right, but that is why I say it's a masterstroke of branding. Like they could have come out and said, hey, we're going to start up a new fund and it's run by these people who are really great investors, and they could have got a better return, right? Historically. But I reckon the fund flows have been driven by the branding and just a master. It is
100%.
They read the
100%.
wind. They read which way the wind was blowing, and they did it. And that has been where all the money has come from. Now,
I agree.
Yeah. Anyway, that's amazing.
No, but that's why it's good. Like if you even look today, like they do a slicker operation. Like Future Super is another example of a slick one. But like if you look at the add-on ethical options for like Australian or Super, it's like it's like a thing. It's a thing they can do to retain someone who might be about to leave. But it's not a selling point that they get anyone in on that I could see.
Yeah, it's interesting. It's just I mean, it goes to show you again, and this is the lesson that I've had like shoved in my face a million times. We are in an industry where it's more about perception than reality. You know, it's whatever, when the ducks quack, feed them, right? It's just sort of like people wanted ethical. ESG was this huge thing all of a sudden. And hey, let's create some products, around that. And that's,
yeah, it is. But it's like, these guys have done it better because they're perceived as more genuine. That's the thing.
Yeah, and credit to them for not being as cynical as others may have been, but it just goes to show you, right?
There is an element of truth in that. Like this is like, I know I followed back the founding story of this company. Like this is genuinely wasn't done cynically. Like it was way too early. It went nowhere for years and years and years. It was just like there and ready when the wave did come.
Yeah, that's a fair point for these guys. One of the risk, kind of like longer term risk with Australian Ethical, I think, is how much the regulator is pushing for consolidation in super. And so they kind of benefited from that with Christian Super, which is like underperforming product. But I guess the risk would be like at some point, if Australian Ethical underperformed, they have relatively high fees, compared to the industry. Does the regulator kind of put pressure on them to start shutting something down or sell to someone else? And do you get good value from that? So it's just something to keep back in mind, I guess.
I think that's probably how the story ends as well, Matt. Like, I feel like that could be any time. If it lasts another 10 years before it starts underperforming, then it should have a great run. But if it really just crashes from here, then you might never get off the mat.
The wild thing with that Christian Super was it was kind of just like ordered. It was like given away, basically. Like they didn't really pay anything for it. So that's kind of the
Australian Ethical can be the beneficiary of that, though, of more of that.
Yeah, I had a look. I don't think there's many more of them, but the risk would be, I guess, the downside risk on the flip side. So on the positive beneficiary, but the negative is, what if they just disappear?
Yeah.
Like, you don't want it to happen to them.
Yeah, exactly.
It's just kind of like a whoa.
Exactly. So that's one thing that keeps me out of it, actually. It's like whenever someone brings up that risk with Australian Ethical, you're like, yeah, and it's also in 40 times earnings. So
it'd be like, it's like, in small caps, you get like acquisition good news. Like, yeah, you're being acquired for $0. Like, what do you mean? I'm sure it wouldn't have like.
No, but we don't actually think that like something that bad would happen, by the way. So like we're a bit tongue in cheek.
It's just kind of stunning it's just wild to me that Christian Super kind of got acquired for basically nothing.
It's wild. It's wild to me that there is a thing called Christian Super. I'm sorry, I don't want to insult anyone's deeply held beliefs, but it's just sort of like, what the hell's that got to do with like, I mean, but again, brilliant, right? Like,
Mate, I reckon I foresee in 5 years after this rant, you moving your superannuation to like a Bitcoin super or something.
Yeah, that's your religion. Don't get down on other people's religions. You know, we need religion, neutral religion.
That's exactly to my point, right? Like, so
secular
BlackRock and all of that.
Tolerance
Doing
must prevail.
Yeah. We even tolerate
the
Bitcoin
only thing
religion.
But you don't be tolerant of intolerance. That's the one thing that we can't tolerate.
It's actually a great example, right? So BlackRock and other players are trying to get into that space. Let's be real, right? I'll be real here. It's not because they see Bitcoin as any great thing. It's because there's.
Oh, you mean that ESG investing stuff?
Yeah. And the narrative is flipped on the ESG side of things too. So it's no longer boiling the oceans, et cetera, et cetera. But again, my point being is that it's sort of, like the Christian fund. It's like, well, I'm Christian and I want to invest my money. Oh, I'm going to go the Christian fund. I mean, it's just.
No, I mean, I don't think the Christian fund came.
Right?
I don't think it came from someone cynically trying to exploit. Anyway, I think that a lot of these things come from, as Claude, like it's from.
But why would you need your? I mean, like if you're a Christian organization and you need to find somewhere for your super, why set up your own thing? I mean, the whole industry is a joke. Frankly, I would say like.
Wait, let me answer that though, because like actually, shout out to the Christians out there. I think that certainly Christianity or Christian investors were massive proponents of early ethical investing. I think you had the Quakers making a stand about slavery, for example, way back in the 1800s. And they were trying to use money and power quite literally to like disinvest in slavery to help set the scene for using government to then outlaw slavery. So I see using capital flows as a completely legitimate way of expressing your views about how the world should be. And that's why I think the more important thing, I think that the one thing I really stand for is people thinking about, like, if there's a guy that thinks more coal mines is the answer and he wants to invest in coal mines for that reason, I would actually say that is a form of ethical investing. And I have no problem with some people expressing their views in that way. So I think that the real missed opportunity is when people abdicate their views to someone else completely. And it does become, monolithic, let's say, and the marketplace of ideas weakens and stops filtering into the marketplace for capital.
Thank you, Claude. I think that's a good defense of it. Do you want to just round out with the last bit on Ansarada, which is one that I think we chatted about a bit before and had some good news as well?
Yeah. So I don't think that there was anything too groundbreaking, but I just wanted to note, because I guess it's another one that's come up since the quarterlies also a lot of these smaller stocks probably got a bit oversold into June there because tax loss selling, but it's up, I think around 20%. It's not one that I've been covering closely. I stopped following it a while back, but I think that the main criticism is probably like, is there enough growth in it? But the good thing about this one is that for the 12 months, you see 5.8 million operating cash flow and just 5.6 million expenditure via investments. So that basically means, given I can't see any sort of lease repayments there, it looks like it's pretty much broken free cash flow positive for the year. So I think that is always a milestone that is probably worth taking note of, because the chances that this company survive and then can just continue beavering away at trying to grow its recurring revenue are improved. Just a note for the listeners who aren't familiar with this one, I think that one of the challenges for Ansarada is its core product, I think, and correct me if I'm wrong, either of you, but it has to do with like deal making. It's like data room software.
Yeah, that's exactly right. Data rooms, so software to manage a data room. So for anyone who's not a merger and acquisitions lawyer, data room is basically a shared site. Some people in the most basic form just use like Dropbox or Google Drive. Actually, I've seen quite a few use that. But anyway, and so it's just like a shared place where you get all the files related to the business, and you can kind of get a look through into their financials, operations, legal, everything. It's like a shared platform. You can see everything going on. And Ansarada's software, some of what they sell is like, that they do good and they make it easy to use, and also do analytics on it so that they can, tell you who's actually looking at your deal, how much due diligence are they doing to see who's going to be the people likely to bid. That's kind of part of their selling point. But yeah, I guess maybe, I don't know if you're going to address this, Claude, but part of the challenge with that is it's inherently, or there's a bias towards it being one-off, not recurring. And that's something that
that's right.
Grapple with.
Nah, you exactly read my mind. So thanks. But still, I say good news for the cash flow positive, and perhaps one to vaguely think about or have on the watch list. I haven't quite managed to put up in my head a sort of cogent reason why I'd want to own it long term, but I wouldn't want to discard it either.
Yeah, and I guess revenue growth, I have to dig into it more, but customer numbers up 96%, but revenue growth was only up 3% year over year. So it could be part of it might have been a harder push onto shifting the business a bit. I'd have to dig into it more about what.
It definitely could be like that. It's just it's an interesting
It's
one.
Yep, for sure.
But, in terms of when we're trying to fit it into why is it undervalued, I can't really say. Does it have some sort of exciting exponential growth prospects? It's hard to say. Maybe there's a pickup if they do manage to get it into a more recurring business. I think that it's just like, it's not such a given. Like when you've got license sales where you sell a license and then 3 years later you basically resell it again because they're addicted to your software. But and then transferring that to a yearly subscription when you already have a super sticky product. I think that is a lot easier than doing what they're trying to do when you'd have some users where it lends itself to a subscription, i.e., you're Ernst & Young or whatever, and you're always doing deals, but then probably a lot of one-off use cases. So I think it's going to be a bit harder for them.
Nice. Any thoughts on that one, Andrew? Or any
Yeah,
closing?
no, I'm just having a quick squeeze through the Prezzo now. I'm really not familiar with it, so I'll just politely stay on the sidelines.
Yeah, no worries. All right, should we
Someone
close it
hop
out
onto Strawman to educate.
there you go. Hit
To educate Andrew, if you like Ansarada.
Do it.
All right, well, let's wrap it there, gents. We'll have plenty more to chat about over the next few weeks with more earnings results coming out. Until next time, you can hit us up on Twitter at BuyBeGiantsPod, and thanks very much for listening.
Oh, and don't forget to send me if you have some small cap good news.
Yeah, nice.
Yes,
Cheers.
that's it. Hit Claude up on Twitter as well.
See you, everyone.